Welcome, guys. This is going to be sort of a lecture style on risk management and how it pertains to day trading. So, what is risk management? Risk management is the process of identification, analysis, and acceptance or mitigation of uncertainty investment decisions. Right? This is how we decide what are the probabilities of our investments and how do we mitigate any potential downside to those. A common definition of investment risk is a deviation from an expected outcome. So when you make a trade plan and the trade goes against you because we don't always win, this is a deviation from our expected outcome and the things that we need to either accept or find ways to mitigate. Risk is inseparable from return in the investment world. In order for us to make gains while trading, we have to risk capital. There is no way around it, and it's just something we need to learn about and plan into our trading plan and trading strategy. There are four main factors to consider when managing your risk concerning day trading. Those factors are as follows: margin, leverage, position size, and then spreads and commission. Starting first with margin. Margin is the collateral that an investor has to deposit with their broker or exchange to cover the credit risk the holder poses for the broker or the exchange. When trading CFDs, futures, or Forex, margin will refer to a good faith deposit used as collateral to open and maintain positions. This is the money you deposit into a brokerage account. That money is then used to buy and sell different assets. Margin requirements to open a position will be the cost basis required to open and maintain that position in the market. So this is going to be how much capital you need to put up in order to be able to open a position with a broker or an exchange. In the event that an investor's total margin, including their open profit and loss, drops below the cost basis or margin requirements of all open positions, a broker will issue a margin call, where positions will be forcefully closed to maintain the necessary funds in an account. In the event of trading on margin, a notice will be sent to investors to increase the amount of collateral before positions are forcefully closed. Margin can also be used in margin trading, which we just mentioned, which is the practice of using borrowed funds from a broker to trade a financial asset, which forms the collateral for the loan from the broker. But trading on margin is only applicable when trading securities, so it's not something we tend to get into in the trading floor. We deal with CFDs, futures, and Forex, where you cannot trade on margin. Next, we have leverage. What is leverage? So leverage is the use of borrowed funds to increase one's trading position beyond what is available from their cash balance alone. When trading Forex and contracts for difference, or CFDs, traders will be using margin-based leverage. To calculate margin-based leverage, we divide the total transaction value by the amount of margin you're required to put up. So, for example, if you are required to deposit 1% of the total transaction value as margin, and you intend to trade one standard lot of dollar Swiss franc, which is equivalent to $100,000, the margin requirement would be $1,000. Thus, your margin-based leverage will be 100 to 1, which is 100,000 divided by 1,000. For a margin requirement of just 0.25%, the margin-based leverage would be 400 to 1, using the exact same formula. And this is because if you were to trade without any leverage, in order to place one standard lot trade of dollar Swiss franc, you would be required to put $100,000 into a trading account to buy $100,000 of US dollar Swiss franc. So that's why leverage is very important for what we do. Now, margin-based leverage does not necessarily affect risk, and whether a trader is required to put up 1% or 2% of the transaction value as margin may not influence their profits or losses. This is because this is just the cost to open a trade, not how much you're actually risking on the trade. This is because investors can always attribute more than the required margin for any position. This indicates that the real leverage, not margin-based leverage, is the stronger indicator of profit and loss. So when trading, you will have a margin requirement that is the minimum amount of money that you need to place into an account to open a trade. That money cannot be removed, if you will. That is the cost of opening the trade, and then your profits and losses are taken out of or added to any margin you have over that. So this is why your margin requirements or the cost of opening a trade will not affect the amount of risk inherent in that trade. Now, we were talking about real leverage. To calculate real leverage currently being used, you simply divide the total face value of open positions by the trading capital. So, for example, if you have a $10,000 account and you open a $100,000 position, which is equivalent to one standard lot in Forex, you'll be trading with 10 times leverage on the account. If you trade two standard lots, which are worth $200,000 in face value with a $10,000 account, then your leverage on the account is 20 times. So your maximum real leverage would be the maximum amount of positions you could have open with the amount of currency or capital you have in your trading account. So this means that the margin-based leverage is equal to the maximum leverage a trader can use. So essentially, if you have 100 to 1 leverage, the maximum amount of real leverage that you can have is basically 100 times of what your value is, your account value is. Now, obviously, a trader should never use all of their available margin. One, because you'll get margin called if you start going into any drawdown on your trades. But by using maximum real leverage, traders can calculate position size and the maximum number of positions that can be opened at any given time. Because if to open one standard lot, you have to put up 1% margin, which is say $1,000 on a $10,000 account, that will equate to 10% of your total real available leverage, right? Maximum real leverage. So you could only open 10 standard lots before you got margin called with the margin requirements. Moving on to an important topic for position sizing. So to paraphrase George Soros, it's not whether you're right or wrong that matters in the markets, but how much you make when you are right and how much you lose when you are wrong. This is a very important thing for us to do as traders because as we talked about in the last panel, it's not about how much you win, it's about how much you're winning when you win and how much you lose when you lose. We want to mitigate how much we lose and maximize how much we gain. That leads to us being profitable traders. Now, how does a trader go about figuring out how much loss is incurred when a trade moves against them? A trader does this by correctly sizing into a position in accordance with the trader's risk plan. Before that can be done, the following 5 pieces of information are necessary. Account equity or balance, which this is the amount of equity deposited into a brokerage account. The currency pair or asset being traded and its contract size or lot size. We'll get into what contract sizes are in a bit. The contract size for assets can be found with the trader's broker. Because in Forex, the contract size will be a standard unit for almost every broker, but with things like futures and CFDs, that contract size can change. The desired percent of risk, of equity to risk. So this is going to be something that is determined by the trader's trade plan. For example, personally, I use 1% risk per trade. I don't use any more or any less than that. It's consistent throughout all my trades. Some people might decide that their trade plan requires 0.25% risk or 2% risk or 0.5% risk. And that's going to be up to the trader to determine within their trade plan and for their risk tolerance. Your stop loss in pips or in points if you're trading in futures and CFDs. This will be determined again by the trader's plan, determining the placement of the stop loss. So are you doing a set stop loss, or are you doing a market structure stop loss or a level stop loss or a fib stop loss? These are all things that will determine what your stop loss is, but that is something that needs to be decided before you open a trade. And then finally, the conversion currency pair exchange rates. So this is relevant when, for example, trading Aussie dollar, Japanese yen, when your account is funded with US dollars. Because in order to open up that asset, you will have to convert the US dollars into either yen or Aussie dollars before then trading that pair and then trading it back into USDs once you close that position. And that will affect slightly the profit per pip. A major variable in determining the position size of a trade is understanding the contract size of the asset being traded and how that affects the profit and the losses, I should say the potential profit and losses of that trade. In Forex, the contract size will always be a unit of $100,000. So one standard lot is 100,000 units. One mini lot or 0.1 standard lots is 10,000 units. And one micro lot is 0.01 of a standard lot, which is 1,000 units. This means for every standard lot a trader holds, they control 100,000 units of that asset. So how does this impact profits and losses? The formula for calculating potential profit and loss per unit of movement in the Forex market is your potential profit or loss equals the position size multiplied by the smallest unit of movement that market can make. This means we multiply $100,000 position size by 1 pip or 0.0001, which is the smallest unit of movement in the Forex markets, which will give a value of 10 per unit of movement. So if trading the euro dollar with one standard lot or $100,000, the profit and loss, potential profit and loss of each pip of movement will be $10 US. Once the profit and loss per unit of movement has been determined, the trader can calculate their position size based on the trade plan. Before getting into that, we're going to cover CFDs and futures contracts because those are an important bit of information to know. So for contract for difference or CFDs and futures, they will operate differently than Forex. Forex has a very standard unit size or contract size. Futures operate on a fixed monetary amount per contract and per minimum price movement. This price is set by the futures exchange. To give some examples, I'll show you in a bit. And for anyone who doesn't know, in the US, the future exchange market is the CME, it's the Chicago Mercantile Exchange. And that is where you trade futures. And the CME, or the Chicago Mercantile Exchange, is the one who sets the contract size. Just a quick note that futures can only be traded in full contracts, unlike lots, which can be fractional. So in Forex, we can have 1.5 lots. In futures, you can only have 1 contract, 2 contracts, 3 contracts. There are no fractional contracts. But to give you some examples of futures contracts, to trade one NASDAQ E-mini contract, you will be making or losing $20 per point and $5 per minimum price movement of 1 tick, which is 0.25 points. To trade one E-mini contract on the Dow Jones will be $5 per point, with points being the minimum price movement. So this one's a bit different than the NASDAQ, where the only price movement is 1 point. They don't have fractional points on the Dow Jones. For the S&P 500, one E-mini contract will potentially make or lose $50 per point and $12.50 US per minimum price movement of 1 tick, which is again 0.25 points. Futures can also be traded in micro E-mini contracts, which are 1/10 the size of the E-mini. So the NASDAQ would be $2, the Dow Jones would be 0.5, and the S&P 500 would be $5. Contract for differences will have a contract size set by the broker, and so it can vary. These contract sizes will usually be 100, 10, or 1 per contract. Excuse me. This means that for one standard lot, a contract size of 100 will equal a profit or loss of $100 per point of movement. A contract size of 10 will equal a profit or loss of $10 per point. A contract size of 1 will equal a profit or loss of $1 per point. And CFDs can be fractional, so you can have, say, 1.5 lots, which with a contract size of 100 would be $150 per point. There we go. CFDs can be traded with fractional lots, so contract size of 100 while trading 0.01 lots will generate $1 of profit and loss per point. So using the contract size of an asset, a trader can then calculate the required position size of a trade to achieve the desired risk in accordance with their trade plan. We're going to use Forex as an example for this because that's more commonly traded. If the trade plan dictates to set a stop loss of 20 pips is to be used with 1% risk of equity given a $10,000 account, the following calculation is made. So we're looking for a set stop loss at 20 pips per trade with 1% risk on a $10,000 account. So the risk for the trade, what we're going to do is we're going to multiply $10,000 by 0.01. That's 1%, giving us $100. We add to this previous equation the profit loss equals position size times smallest unit of movement, which we calculated in the previous slide. But what we're going to do is we're going to multiply the smallest unit of movement by the desired stop loss giving the formula. The potential profit and loss equals our position size multiplied by the desired stop loss multiplied by the smallest unit of movement. So to put this into numbers, when we plug everything in, the values for the trade that are plugged in is $100 for the desired risk and a $20 pip stop loss, which gives us $100 risk, profit loss, plus the position size times 20 times the smallest unit of measure for Forex is 1 pip, which is 0.001. The formula is then solved for the position size, giving us position size is equal to $100 divided by 0.002, which equals 50,000 units. This means that in order to trade a $10,000 account with 1% risk and a 20 pip stop loss, the position size will be 0.5 standard lots or 5 mini lots. So finally, the last portion of risk management to understand, and I'm going to give you the theoretical portion here, is spreads and commissions. This is going to be theoretical, and then we're going to go into a practical demonstration with Sven. So in finance, a spread refers to the difference between two prices, rates, or yields. One of the most common types that one dealt with the most frequently in day trading is the bid-ask spread. This is what everyone has to deal with whenever placing a trade with any broker. This refers to the gap between the bid from the buyers and the ask from the sellers of any price, and the ask prices of any security or asset. So this is the difference in price between what buyers are offering and what sellers are offering for a security or asset. To understand why there is a bid and an ask, we must factor in two major players in any market transaction, namely the price taker, who is the trader, and the market maker, who is the counterparty to that trade. Market makers, many of which may be employed by brokers, offer to sell securities at a given price, the ask price, and will also bid to purchase securities at a given price, the bid price. When an investor initiates a trade, they will accept one of these two prices depending on whether they wish to buy the security, the ask price, or sell the security, the bid price. The difference between those two, the spread, is the principal transaction cost of trading outside of commissions and is collected by the market maker. Essentially, they act as the intermediary and provide liquidity, and that's how they take a cut, if you will. Finally, the size of the bid-ask spread from one asset to another differs mainly because of the difference in liquidity of the asset. The bid-ask spread is the de facto measure of market liquidity. Certain markets are more liquid than others, and that should be reflected in their lower spreads. Essentially, transaction initiators, price takers, demand liquidity, while counterparties, market makers, supply that liquidity. So this is why you'll see on things like the euro dollar, you'll see a 0.2% or 0.2 pip spread or a 1 pip spread. Whereas if you go and try and trade Aussie dollar, Japanese yen, or pound Aussie, you're going to see a 2 pip or 3 pip spread because there's a lot less liquidity for that currency pair. And then finally, we're getting into commissions. A commission is a service charge assessed by a broker to provide liquidity or handle the purchase and sales of securities or assets for a client. There are 3 types of commissions used by brokers in Forex. The fixed spread, which is a fixed pip spread, and it will be determined for each asset. So they'll say 1 pip is the spread, that is the spread always, doesn't matter, that's what you pay. A variable spread, which is more commonly used, will vary with liquidity of markets. So this is why when markets close daily for 1 hour after New York, you'll notice that spreads increase drastically because there is zero liquidity happening, and anyone who wants to place a trade, which some people can actually trade outside market hours if you have special access, that increases the spread, and because there's such low liquidity. And finally, commission based on position size. This is a flat commission rate charged either per trip or per round trip. Usually commissions are per 100,000 units or 1 standard lot, i.e. $3 per round trip. So in futures, it'll be per contract. In Forex, it'll be per lot, essentially. And just to note, the terminology round trip means it will be charged once for opening and closing a position. So if it's a $3 per lot round trip, you will be charged $3 to place and close the trade. Whereas if it was charged per trip, it will be applied upon opening a trade and then again when you close the position. So if you had a $3 commission per lot, per trip, it would be $3 to open the trade and $3 to close the trade, for making a $6 round trip commission. And that is all I have for this presentation. So now the theoretical side is done. I'm going to pass it over to Sven, and Sven's going to kind of take you through how to practically assign this information to your MT4, TradingView, etc.
Let's get practical. So thank you, Bear, for the theory. I think stuff like this, you really have to go to the practical side to actually understand it. Because theory is just numbers and a formula, but you have to handle it on the practical side. So I first want to go back into the spread and how you can actually see the spread. Because we often see people ask like, hey, I'm in a position, it did hit my stop loss or my take profit, but it was taken out. Why is that happening? And often it's because of spread. So I want to maximize my MT4 on the right-hand side. You have actually 2 different ways to actually that you show the spread in MT4. The one is you can right-click on the chart, go to properties, and under common, you can actually say show ask line. And this will then show you, or not. Could be a spread right now, so I'm not seeing it. Normally you should see a red line. Let me zoom in a little bit more. There we can see it. So we're currently on EURUSD, and that's probably the lowest spread pair that there is. So you can see the red line is the ask price, and the gray line is the bid price. And normal prices is given in the bid price. And a handy rule of thumb is you don't have to remember if you buy on the bid or on the ask or whatever. Just remember that you always buy at a higher price. So you always buy on the red line and you sell on the gray line. That means if we would enter a buy right here, I would buy on the red line and could sell it back on the gray line. That immediately when I'm in the position, I am in a little bit of drawdown because of spread. So the first option to see the spread is to put it on your charts by actually setting it up to show the ask line. The other thing is you can go over to the market watch, right-click in there and choose spread. And then MT4 will show you the spread. Don't get panicked if you see high numbers here. Spread is given in the number of digits that actually the broker is giving you. Most broker nowadays go to 5 decimals. That means it's a pipette, not a pip. So this instance, for example, EURUSD is currently at a 0.2 spread, so very thin spread. That's why we really had to zoom in to see it here. So these are the two ways to actually see spread. Also, I want to show you the difference between a raw spread, where you pay commission, and a fixed spread or non-commission pair. You can see in my market watch, I have actually 2 EURUSD pairs in here. One with the little C in the back. That means I pay commission here. I get a raw spread, but I pay commission for every lot size I buy or sell. Then down below here, same pair, EURUSD, but without the C. That is a no commission pair. So my broker, it's my private broker I use for my private funds. He offers a raw spread with commissions and no commissions, but a bigger spread. And you can see the difference here. With the raw spread, 0.2 pips. With the non-commission, no commission based, 0.8 pips. So quite a difference between. And I always recommend use the commission-based model. It's typically better. So you won't have a raw spread. So now that we understand spread and what happens with the spread, so you buy on the higher one and you sell on the lower one, that means you typically should implement a spread into where you place your stop loss and you take profits. Because when you actually plan it in TradingView, you only have the bid price, and to make actually your risk to reward be reflected in your actual trading, you have to account for the spread in your position. Also, you want to really get kicked out of the trade when your level is broken, and that also has to be considered of the spread. Let me quickly check if any questions for that so far. No, okay. So then we want to tackle the next question we often see. It's the difference between TradingView and MT4. So the majority of people probably will do the charting and everything on TradingView, and then the order execution actually enter into trade on MetaTrader. And as you can see here, I have the same pair currently on EURUSD. The price will be slightly different. That depends on your broker. For some brokers, you can find a really good match. That should be also your first task, to find a feed on TradingView that comes close to the prices you see in your broker. It just makes life a little bit easier. So that's the first thing you want to do. And then you can see there's still always a difference, and it depends on your broker. The difference could be way higher. So right here, with my pair between the Oanda fee on TradingView and my broker, it's only around 2 to 3 pipettes. So that's nothing major, but it could be more, of course, on other pairs. But there's something to be aware of. So let's say we want to place a trade here. It's not about the strategy. That's just some random example. There's no real entry here, but just for the sake of the argument, you want to go long on that level and have your short, your stop loss maybe down here, and then you take profits somewhere up there. Doesn't really matter. We only talk about these levels right here now, because take profit is not important for risk management. It's just only for your overall gains. So we will focus on entry price and stop loss price. We have that menu. Now the time is like, okay, I want you now execute an MT4. You have 3 different ways of actually transferring that kind of setup to MT4. And we want to go through them real quick. So the first option you have is to read the price levels and transfer price. What does this mean? So we could say, okay, I know that I enter at that price, and I will have my stop loss on the price here, which is around 1.05076. So I could actually say, okay, I want to enter that here and put my stop loss. So we enter add a buy here. And I could place that number, that line, my stop loss line, at the same price level that I read out in TradingView. That will be in somewhere just a little bit different because the price action will look different on MT4. That's the first option. The second option is to read the distance. So that means the pips of your stop loss and transfer that. So I could say from my entry, in that case, I would have a 10.2 pip stop loss. So I could then, again, go into my MT4. You can see here it's pretty handy with the trade manager. With the risk manager, you see the pips. So I can actually then move the line down until it reaches 10.2 pips. Let me zoom in a little bit more so we can see the price action. So it will be a similar area coming from the market structure, but it will be a bit different than what we have in TradingView. That's the second option. The third option we have, and that's the one that I personally prefer, is look for the same structure. Look for the same structure in TradingView, in MetaTrader. So in this instance, you can clearly see I'm on my entry. I said, okay, I want to have my stop loss below the candle bodies. I'm cutting the wicks. That's how I would have defined my stop loss here. But for whatever reason, doesn't matter. Just to get a trade going. So in that case, I don't care about what price this is in TradingView. I don't care about what specific pips that stop loss is. I just put my line at the same level. So I'm cutting the wicks here too. Not a big difference. You can see before that we had 10.2 pips on TradingView and 10 pips here. So that's not a big difference. But this is now, with that method, you actually aligned the market structure to your actual data feed. And of course, in that case, I would add the spread to it to account for that. But in this case, since it's all UUSD, the spread is so thin, it doesn't really matter, but for other pairs, it might matter. So these are your three options to transfer what you have planned on TradingView into executing on MT4. And as said, I would recommend doing the number 3, so we actually put it on the same structure. It takes a little bit more time because you have to do basically a bit of reviewing the charts again on MT4 to find that same structure you want to put it on. If your strategy, for example, but takes a fixed stop loss, like you want to take always 20 pips stop loss, for example, like the Lorraine, some people do that, then it's easy because you can just copy over the stop loss in pips, and then it's fine. Okay, next thing to tackle is then the calculation of your position size. I want to go a step back. Yes, we already have the risk management on here, and that does the trick. But we want to take it first to a web-based calculator. So you can do it by hand, but there's no need to do it. I think it's important to understand how you have to calculate the risk, how it's actually done, what the formula is saying you. So basically what Bear has shown us the last half hour. Please make sure you understand it because it's part of your craft and you should really understand the ins and outs. But for practicability for your everyday life as a trader, you don't do hand calculations. It's good to understand and have a good feel for it, but you don't do the calculations yourself typically. So one thing you can use, especially probably more for the people who trade on mobile, because you cannot use an EA on mobile MT4 and MT5. So you have to go back to either knowing roughly your position size or you take a web-based calculator. This here is the one from Cashback Forex, where you put in what instrument you want to trade. We go back to USD. You put in your account balance. You put in your stop loss. You can also switch it to your stop loss price. So you tell them when you entered and what your stop loss is, and then it calculates the size of your stop loss based off that. But I typically put in my stop loss as pips. And then you put in your risk, and then it runs the calculation based on that. So that's the web-based version you can do. But of course, if you're on your computer, is the most handy thing you can do is just grab a risk manager, trade manager. For example, the one we have from the trading floor, it's free for your, including your membership. So nothing stopping you to using it. And with the risk management, you input your risk percentage, and that calculates what is your cash risk. And you also can put in your ratio. This is what for the trade, where take profit then is based on your stop loss. And so I get that thing going. So this is the chart you see, and then if you hit buy, it puts in your stop loss line. And if I scroll back out, you see the take profit line all the way up here. We will focus on the stop loss. And then you can just drag that around and place it where you think it should be. So for example, if in that example, you want to take the trade but you want to put it below the wicks, plot a little bit of spread, place it here, and then you can see it calculates it for you. So it tells you the first number below the line is your stop loss in pips. It tells you your stop loss amount if you lose it in USD, how much percentage it is, and how much volume, so the position size that will be then if you now would hit buy. The numbers will fluctuate because we, of course, right now it's a market order, so the price is moving, so our stop loss gets bigger or smaller, but that's about it. So pretty handy. Two things are important to understand, as there are certain limitations. And those are actually, you can see them in specifications. So if you trade an instrument, always make sure you right-click on it, hit specifications in the market watch, and take a look for these numbers. So you want to check contract size. For Forex pairs, like we learned from Beth, always 100,000. But for indices, it can be different. Some use 1, some use 10. I think I even saw someone using 100. And this, of course, makes a major difference for your stop loss. And you also will pay attention to the minimal volume. So that means the lowest position size your broker will let you open. And you want to pay attention to the maximum volume, which means the biggest position size your broker will let you open. And of course, then the volume step, which means how the increments are, how much you can increase that from based on the minimum volume. Typically, minimal volume and volume step is the same. So if you see a 0.01 here, you know the next increment would be 0.02. So adding 1 microlot to it. And these numbers then you can understand in how big a position you can open, from the smallest to the biggest. And I want to show you something you also have to aware of, that if your account gets small, you can run into the problem that your position sizes that you need would be less than you can actually take. So let me quickly reduce my risk here, 2.1%, so only $10. It's a $10,000 account. And if I increase my stop loss, that means my volume, my position size will decrease when I increase my stop loss. You can see the numbers going down. Now it would open 5 microlots. And if I move my stop loss further down, at one point, I really have to move it a lot. I should have probably made a smaller account for that. It will be at the minimum volume. At that point, you see the first difference happening. So I would like to risk $10, but right now it would be $5.7 because the risk manager cannot go any more granular, so it cannot fit my risk property like properly anymore, because it cannot. The next step higher would be over risking. It has to step down, because if it would risk 0.12, so 2 microlots, it would be above $10. Therefore, the risk calculator says no, I can only use 1 microlot. That means right now you would be under risking with that position. If we move it further down, you see that my risk in the trade is going up because my stop loss is getting bigger. And now we're already above $10. So this is above what I was willing to risk. And this goes, I can do it infinitely, basically until it goes to 0. And that's the other thing. And you have to make sure and understand your risk calculator. Some will open that trade as a micro lot, as the minimum volume. Some will not open because they know this is above what the customer was telling me he wants to risk. So be aware of that. That's the one limitation you see. So you have to understand that if your account is small, you will, if you get it, bigger stop losses. It depends on your strategy. You might see quite often the problem that your actual risk you're taking, this is not the risk you want to take, because the granularity that about the position size you can open does not allow you to actually be right on spot with that. And that's a problem if you either have a very small account or you have very big stop losses. The other limitation we have is the maximum volume. So if I go the other way around and I pump up the risk to demonstrate that, and then I make smaller stop loss. Smaller stop loss means I will need more lot sizes to actually get to my preferred risk I want to have. At one point, I really have to pump that up. The account is too small to actually show that. So right now I'm already at 49 at, okay, now we jumped. Right now I'm already at close to 90 lots, and we know from going into the specs, we do it again, that the max volume is 100. That means at one point, if I do my stop loss smaller, it will not move any higher, because the risk management knows if it reads the specification that you cannot do more than 100. So in that case, you would be under risking again. These are the two limitations that comes from the position sizing. Next up, we want to move away from Forex, because Forex is rather easy because always the same contract size. But let's take a look at an index. So let's go to here US Tech, which is the NASDAQ, and do the same thing. So make sure you check the specifications, and then we can see once again, minimum volume is 1 lot. So we cannot do a micro lot here. And we see the same maximum volume on the lot for this specific broker. This is specific to the broker. So always check your own broker. And you can see contract size is 1. So in this case, you know, if the NASDAQ moves $1, your position also, if you have one lot, will also move for $1. You also can use the web-based calculator for that. Make sure you have put in the right contract size, and then put in whatever you have as a stop loss, and then you can calculate your position. But then again, you can also use the A for that. And here, since we cannot do micro lots, the effect is even bigger if you have smaller accounts. So here, let's simulate a $1,000 account. That means if you want to risk 1% on that, that's 1.1% on the $10,000 account. And you can already see, let's make my MT4 bigger, we don't need the cash calculator anymore, that even with a rather normal stop loss, so now we're talking about 32%, 32 pip stop loss, I'm already running into the problem that I'm risking way too much. You can see I cannot go small because I'm already at a min volume at 1 lot. And right now I would be risking $30 instead of my $10 I want to have. That's one of the issues we have if you want to trade indices with smaller accounts. That you typically, so many stop loss we see within our trading, and essentially we have on the trading floor, you're between 20 and 50 pips quite often still. And that would put you right there with a $1,000 account, but you could not trade it properly because you would be massively over risking. Let me see if there are any questions.
None yet.
Not yet. Okay.
Well, I've been answering some of them text-wise.
Okay. I think I forgot something, but
Or did you show the spread in the Market Watch as a place to find that? All right, I missed that when I was checking something. Yeah, I think you covered it. One thing that I will add is when considering spread, especially when looking at, so one of the common problems that people have is they'll look at TradingView where they've marked up their trade, or they'll look at their MT4 where they have their take profit lines, and they'll see that price hits their take profit line and then comes back and for some reason the trade is still open. And this is something that is affected by your spread. So just like you see the ask and bid price on the chart, if you have let's say a 2 pip spread, and price is, so we're going to say that you have a 20 pip stop loss and a 20 pip take profit, and your spread is 2 pips. In order for your broker to fill the take profit order, right? Because that's an order that has to be filled. When you get to that price level, in order to fill, the current ask or bid price will typically be 2 pips above your stop loss. So in order to meet your stop loss of 20 pips, price will have to move 22 pips to get there. So if you hit exactly 20 pips and then it rebounds and you have a 2 pip spread, typically your take profit won't fill and you'll end up just remaining in the trade until it blows through your take profit. And that's something that people are like, I don't understand. I hit my take profit, but my trade didn't close. That's typically what happens. And conversely, when your stop loss gets hit before it even gets down to the bottom, same thing will happen. Is in a buy, your stop loss, your spread will be 2 pips higher or lower. In a buy, it'll be higher. In a sell, it'll be lower than where your stop loss is listed. So if you have a 20 pip stop loss, if price moves 18 pips with a 2 pip spread, you'll get triggered at 18 pips and the account will the trade will close. So typically what I do personally to account for this is if my broker has a 2 pip spread on Euro USD, then I will, if I have a 20 pip stop loss, I will place my stop loss at 22 pips. That way, in order for my trade to be closed out, the price has to move 22 pips and I will be closed at 20 pips. We have a couple questions. Would you recommend using Magic Keys digital for indices instead? Magic Keys and the TCF risk calculator will work the same as far as an EA is concerned. They will still have a min lot problem. They will still have, because they're just calculators.
So it's important to note the min lot problem I was talking about quite a lot. It had nothing to do with the calculator. It has to do with what your broker allows as the minimum lot. And you just have enough money to actually make that worthwhile. So we can actually use that example right here, because it's also the next question from Donovan. Prefer to start with any account size would be 3 to 4K. And it depends on your stop loss typically. So let's say you know that your typical stop loss is 50 pips. So if I move that to 50 pips, you can see the minimum that I will risk is $50. So you have to have an account at the size that you risk whatever you want to risk, like in percentage, is $50 or higher, because then you know you can open that minimum lot size. So for my broker, it's 1 lot as the minimum. And therefore 50 pips means it's $50.
Yeah, and for my broker on US 100 or the NASDAQ, my min lot is 0.01 lots. So I could go much lower than Sven can. So it's going to depend. And this is a lot of why we talk about when you look for a broker, these are all things you need to consider, right? These are the main factors of your risk management: your position size, your margin, your leverage, and your spreads and commission. These are all things that need to be considered in the equation of how much am I risking with my strategy? Can I do it, right? If you have an account that is 1 to 5 leverage, you're going to struggle to place trades because your trades require a certain amount of position sizing, and 1 to 5 leverage is not nearly enough. Or maybe you're someone who needs to open up a lot of trades at like 0.5% risk or 0.25% risk, and you need lower margin requirements to be able to have 2 or 3 positions open. Or maybe you hedge trades with your strategy, and because you're hedging a lot of trades, your risk is lower, but you have a lot of margin requirements. So then you need a broker with a larger leverage. So all these things you have to take into account in determining what broker you're going to use, how you're going to implement your risk into your trading, how you're going to adjust for that risk, and then mitigate and accept that risk.
Also, I see a very good comment from Axe that spread is not fixed for most brokers.
Yes.
So spread will get very tiny if you get high volume. So that, for example, right now UUSD, we are currently in Asia going towards Frankfurt Open slowly but surely. So there's quite a decent volume already in the market. So that means the spread gets tight. If there's not a lot of volume in that currency pair, the spread will widen. And for example, let's take a look at NZD CAD. If I zoom in the same way I was in the UUSD, you can see the spread is way bigger. You can see it over on the left-hand side too. We have a spread of 1.4 pips. And these spreads can go way bigger, especially over the midnight. How do you call it correctly?
Market closure.
The reset. Then the spreads really widen for a few minutes. So
to give you an idea, I once saw a 33 pip spread on pound yen during market reset. So that is also something to understand. Is like, sign into your broker during the market close and check the spreads, right? Because that'll also be an indicator if you can hold overnight or over the weekend, or if you need to make sure you're closing trades beforehand. Or if you want to hold overnight or over the weekend, then you need to say, okay, I'm on pound yen. I need to make sure that I am at least 50 pips in profit on this trade, or 50 pips away from my stop loss to make sure the spread doesn't take me out. Because there's no reason to be 50 pips or 30, 30 or 50 pips in profit, and then all of a sudden your trade closes negative. You're like, wait, what? What happened? And the price is still in profit. Your spread just took you out. So that's always something to consider as well.
A neat thing you can do, especially if you only trade a handful of instruments, there are indicators for MT4 and MT5 that lock the spread. So you just put them on and let your MT4 run for a day. And then you can see how the spread evolves during different hours. This gives you a really good idea how small the spread can get during the perfect market condition when that pair is traded frequently, and then in the off sessions when that pair has low volume. So it would really, if you know that you're stuck to a few markets, do that exercise, because it will give you a very good feel for the market if you hold positions for longer than a few hours, or positions outside your entry session.
Brian asks, I've not used Magic Keys for futures, but I'm assuming you just enter in 1% risk like trading other instruments, and it will act the same way. That is correct. So just like with the TTF risk calculator, Magic Keys can do a percent risk, it can do a fixed dollar risk, or it can do a fixed lot risk. Either one.
Actually, I do not know, because I don't think that MT4, MT5 actually has futures.
I think he meant indices.
Okay, indices, yes.
Yeah,
futures, no.
You can't trade futures in MT4. You have to use a futures broker and their platform. So you can't trade futures with MetaTrader or the TTF risk calculator or Magic Keys. But that one, the risk calculations for futures is fairly easy because it's whole lots, it's whole contracts, right? So if one contract is $2, 10 contracts is $20. And if you're gonna do one contract with a 10 point stop loss, one contract 10 points, that's $20 risk. So it's very easy, really round numbers and super easy to deal with for the most part. Yeah. So it's slightly different. You can't customize your risk the way you do Forex and indices. You have to understand the contracts, the set risk, and then scale in or out accordingly.
So why we have some extra time, an indicator I really like and always have on MT4 is the candle timer, because that also then adds the countdown to the candle. If you're trading on smaller time frames, that can be important, because there's a difference also between MT4 and TradingView. Since the new candle is generated when a tick, so the next price movement has happened within the new time of the new candle. So it can very well be that on the data feed, the previous candle has complete, but a new candle does not start in like, I don't know, 5 seconds in, because that's when the new tick data is then available. So there can be some difference between TradingView and MT4 when the new candle starts. And if you have like, for myself, for example, when I trade on the 1 minute, I have very aggressive entry techniques where you have to be on point, and waiting for TradingView to make the new tick actually makes me lose a few seconds, and that can play a role in how well the trade goes. And also, I like the point that I like the information when the candle close, because many of those strategies you enter on candle close, and you have everything. You have everything transferred from TradingView to, you know, have your stop loss and you take profit here. The only thing that's missing is the candle close, and I like the countdown on TradingView, but I don't want to switch around between. I have everything set up in MT4, but I have to look on the candle timer on the TradingView. I have to look back and forth. So instead, I put on the candle timer in TradingView, in MetaTrader. So once I have transferred my trade plan to MT4, I have everything here I need.
Wow, I've been trading over a decade, and I had no idea that candle timer existed. I just always looked at the clock. I mean, granted, I trade 1 hour, 4 hour charts, so it's not terribly pertinent to what I do, but yeah, thank you.
You're welcome. I find it pretty neat. That's why I have it on all my MT4 charts.
Yeah, that's really neat. All right, well, we're wrapping up here. So if anybody has any final questions, go ahead and drop them in the chat. We'll answer them. If not, we're gonna enter for a longer intermission this time before going into our next panel. We'll give it. I know there's a delay. We'll give it a few minutes.
Maybe a word to the newer traders. So I remember when I started looking into Forex, even though I'm not stupid, I found actually understanding how to calculate my position rather difficult. But it's really not. So once you wrap your head around it, it becomes really easy. So just stick in it and really understand it, because I cannot repeat myself often enough. If you want to make trading a living, you really have to understand your craft, and risk management is the #1 thing. So make sure you understand the ins and outs of it, even if it might take a few minutes to sit at your desk and really understand how the formula works with risk management and everything. It's worthwhile in the end, even though we have all these tools. So actually, we wouldn't need to bother, but it's good to understand what's really happening behind the indicator or behind the website calculator.
Yeah, Sven, someone asked, where's the candle timer on MT4, MT5? If you could potentially drop after the set is done, could you drop a link or something in the Discord?
I have to check, because it's from the MT4 for MQL marketplace. So it's a free indicator from Blatech.
So could you show how someone could find that potentially?
I don't think it's that easy, because the market there's a market within the MT4, but I think that kind of sucks. But we can actually see if that kind of works. So we can see it does not work.
I would go on Google and type in MT4 or MT5 candle timer, and you'll probably get a link to the MT4 marketplace for a download. There's a lot of free indicators for that. So, all right,
now it has come back to life. Let's see if it found something. No, it just completely disregarded my request.
Oh, nice.
Nice.
Appreciate that, MT4. All right, guys, we're going to wrap up this panel. We're going to be taking a little bit of a longer intermission this time, about 1 hour.
Oh, actually, this time it worked.
The next panel that's going to show up is going to be Outback. It's going to be our first trading panel and discussion for the day. and the Stonk Lord himself, JSav, the savvy trader, will be back with lemons to talk about Outback and all the tips, tricks, facts that you need to know about Outback. So it's been a pleasure, guys, and we'll see you in the next panel.
Bye, and thanks for listening.